Hello, everyone. Welcome to this very special edition of the Final Bar live at the CMT 50th Anniversary Symposium. My name is Dave Keller. I'm the Chief Market Strategist at StockCharts.com, usually coming to you from Redmond, Washington, today coming to you from New York, New York. Seeing a lot of friendly technical analysis faces in the crowd, which is awesome. I can also check off the box of watch Louise Yamada and Ralph Acampora dance to my theme song off the list. That was a bucket list item that happened live here just moments ago. So that was really, really cool to see. So thank you guys for that unscheduled dance break. Here's what we're going to be doing here. We're going to do a little different format than normal. A number of you have said hello, that you watch our show live every day after the close on StockCharts TV. It is so awesome, and I appreciate it. Tell your friends. We have a lot of grand plans for StockCharts TV and the Final Bar over time. But I really appreciate you guys sharing that you're watching the show. Couple quick announcements, and I'll give you a sense of what we're going to do today. First off, I want to welcome all of our viewers live on StockCharts TV around the world. We have a wonderful following that is continuing to grow, and we appreciate all of you here in person, of course, at the CMT Symposium, but also many of you watching virtually from wherever you're at, and also watching on delay for those of us on the West Coast, normally watching it at 1 p.m. Pacific. We'll have it for you later today as well. I also want to thank a number of people. First off, thanks to Tyler and to Bill and the team at the CMT. I will take credit for the fact that I was, I think, president or on the board certainly when we hired Tyler. So all the good things you've seen from Tyler, you're welcome. And the other stuff, it's a big board with a lot of competing ideas. So maybe someone else had the idea. But I'm proud of what Tyler has done as in many ways, really the front face of the organization for many of you, and I appreciate it. I also want to say thank you, and I apologize to Bill Kelleher, because I personally invited him 10 years ago, actually probably 11 years ago, to take over as the symposium chair. I remember having the conversation after the one symposium and asking him to do it. I did not know it was a 10-year life sentence that I was giving him, but he has done a fantastic job driving that as well, and thanks to that. Yeah. And also, if you've not had a chance to meet Joelle Panikot-Kaizad, Joelle's wife Ina, in from Mumbai, they're doing a fantastic job of working behind the scenes and in the front of the scenes for many of you outside the U.S., and I want to acknowledge how well they've done. They were incredible hosts for us in Mumbai. I hope they've enjoyed their trip to New York, and I hope you can say hello to them. So thank you, guys. I will tell you this, StockCharts is very proud to sponsor the 50th anniversary. We are also very happy to partner with the CMT Association as much as possible. I'm very biased as a former president of this organization to make sure that these paths are very tangential as much as possible. Many of my guests, if not most of them, are CMT charter holders, and I plan to continue that for the foreseeable future. So thank all of you that have come on our TV programs and elsewhere. I also want to acknowledge the StockCharts team, a number of which are here. Julius de Kempener, many of you know as the founder of RRG Research. He is a longtime StockCharts contributor. He will also be operating some of the charts we'll be seeing in a few moments, so I appreciate his help running things. I also want to acknowledge Sky Boggs, who's our producer of the Final Bar, who's here, talking in my ear. So if I ever seem distracted, imagine someone in your head at all times as you're trying to host a show, but overall it's pretty positive. And Sarah Fung, who's our head of marketing, who's here to make sure that we do a good job. So thank you guys for joining me. The mission of StockCharts TV, I was asked about 4 years ago when I joined StockCharts as their chief market strategist to create the CNBC for technical analysis. I was not given a lot of direction on exactly what that meant, and we're still trying to figure that out. But I will tell you what I've learned, having talked with Chip Anderson, our founder, John Murphy, who is our chief technical analyst, and many others. John was a longtime contributor to CNBC. Many of you probably saw him. Many of you probably read his book, like I did. It was the first book I ever read about charting. And having worked with John and Chip and others, John was always a little kind of underwhelmed by how traditional media would handle charting and technical analysis. He was front and center technical analyst on TV, but he always thought there was were better ways to do it. And working with him and with Chip on how we could do a series of programs really focused on elevating the practice of technical analysis and elevating the discourse about charting with our audience. That is what we're trying to do. And I think John's pretty proud of what we've been able to do so far. When you see what we'll be doing from our new studio in Redmond, Washington in the coming months and years, I hope you'll be proud as well as a community of how we are trying to really educate others about how to use technical analysis. So I hope you find the programming enriching, and I hope John and others are proud of where we're headed. Having said all of that, our normal show starts with a market recap. So I feel a little bit like I think my students at Brandeis University felt when I asked them to stand in front of the class and talk about charts, because I'm now speaking in front of two of my mentors and trying to talk technical analysis. So I hope you grade me well as I'm doing this. But what I wanted to do is just set the stage with what the markets are like, right? Where are we at? We've had some really good conversations here over the last day or two about the current conditions, but I want to show you, using StockCharts, sort of where we see things. So Julius, if we could go to the first chart, we're going to start with the S&P 500. And, you know, we're going to ask you a little later about what you think about the S&P 500. So if you have your phone out, that's great. If not, if you have it handy, we're going to be using that polling system that we've used so far. We're actually going to poll everyone here in person in a little bit and discuss that as a group on what we're seeing and hearing. But when I think about the S&P 500 chart, here's my take relative to what we've heard so far. Look at where we're at right now, and we'll call that the final bar, right? The current bar on the S&P 500, and look to the left. And very simply, look at how many times the chart has been at this exact same level in the last 12 months. A lot, right? I was at a dinner earlier this week with some of you in the room, and the market was described as the sloppy chop of the market environment, and I think that's pretty accurate, right? We're in a bottoming process. We're in a process of some sort, but it's certainly not a moment. It seems to be evolving over time. And I think for many of us in this room, we're challenged with the fact of how do you generate alpha? How do you generate positive outperformance at a time when the markets are so stagnant, right? Do you go to derivatives? Do you find, you know, pockets of opportunity within a space that's pretty challenged? Now, not all of the market looks like this chart of the S&P 500, and I think I'll be asking Ralph and Louise in a little bit to talk about and comment on some of those areas where we've seen strength, things like materials and technology, communication services this week, for sure. So chart number one for me is the S&P 500 and just the, you know, the overall movement, career-busting moves that have happened, but overall the directional sense over time is flat. And on our programs, we've talked a lot about this in recent months, and I think that is I don't think we're through that wilderness yet, at least from my read of the chart. We'll see what all of us think here in a few moments. The second chart, if we could, Julius, is one I simply call the chart. And this comes from years ago when my colleagues at Bloomberg would say, what does the chart say about blah? And they would bring something up. And so I jokingly started having something ready. I would say, yep, here's the chart, right? You keep asking for the chart, here it is. And I would just combine some of the key things that I thought were important to follow. So when I'm looking at the chart, it combines a series of different technical indicators, a series of different pieces of information. At the top, we have that same chart of the S&P 500, and then we go through a series of data points as well. The second line down is the advanced decline line on the New York Stock Exchange. You'll notice that looks similar to the S&P, but it doesn't look exactly like the S&P. There's this little issue we have with the cap weighting that's come up a number of times. I know Julius, I sat in on part of his discussion of the RRG methodology, talking about market cap and how that can influence things. We're certainly seeing that impact for sure. That next line down is the percent of S&P 500 stocks above their 50-day moving average. It's right about at 50%. Which means while the S&P is sort of testing the upper end of its range here recently, it's a coin flip right now between how many stocks in the S&P 500 are above or below their 50-day moving average. So when you say the market's overwhelmingly bullish or when the market's overwhelmingly bearish, by that simple measure of breadth, it is the definition of neutral. It's right at 50%. It's an RSI at 50, right? It's a neutral. It's an unchanged sort of value. The next line down is the bullish percent index. It was awesome to see Ken Tower recognized as a service award recipient, well-deserved. And I have very fond memories of sitting next to Ken and grading point and figure exams. We're grading the CMT level 3 point and figure charts. Those were long days, but a lot of fun. And I enjoyed getting to know Ken as we commiserated on different answers and debated how we should be challenging people to know point and figure charts better. We have a series of breadth indicators driven by the point and figure methodology that we have on StockCharts.com. And this is called the bullish percent index. What percent of the point and figure charts in this universe are bullish right now, have given a bullish signal? And if you look, you can see overall, it's kind of dipping back down to right about the 50 level. Now, it had popped above 50%, it had gone down below 30% and gone back up. And that, I have found over time, has been one of the great buy signals of the last 6 to 12 months, has been when the bullish percent index has gotten so negative and starts to turn higher. So we're just maybe seeing that and now seeing it lighten up a little bit. The bottom one deals with offense and defense and how the fact that on the consumer space, the defensive part of consumer has outperformed the offensive side. People are opting into things you need versus things you want, which for me is not a bull market sort of configuration. The next chart, if we could, Julius. The VIX. I've had a lot of debates and discussions with even people like Larry McMillan, who literally wrote the book. Larry McMillan wrote the book on how to trade options when they were just getting started, as we hit the 50th anniversary of the options market, which we were just hitting this month. When you look at the options market, the VIX is derived from the options, equity derivatives. There's a whole new part of the options market, the zero DTE, 0 days to expiration. It's an open question as to how much that is impacting the VIX. I don't know, and I will tell you, I'm happy to say I don't know. And if you take anything away from the show, don't be afraid to say, I don't know, if you don't know. We are very good at saying we know, even when we don't. I don't know what the impact is, but I do know that the volatility right now is not what it usually is doing when the market's really rupturing. The VIX tends to spike, and we're not seeing that. So I think that's one, certainly a configuration to pay attention to. The fourth chart, if we could, gets into interest rates, and I'll save a little of this because Louise has some much better long-term charts to make sense of things. But I think looking at the 10-year yield over the last 12 months has probably been the most important chart out of all of them, because it's told you about leadership. It's told you about what types of stocks and themes tend to work in a rising rate environment. And I'll save the rest of my comments for Louise. But the TLT, the ag, have not broken out yet, right? Yields have not broken down yet. Bond prices have not broken out yet. But yet may be the most important word in that sentence. Finally, leadership. And I just wanted to share this with you to show the performance of some different key asset classes over time and really particular areas of the market. On the next slide, if we could, Julius. If you look at the year-to-date performance in some of these key names and key areas of the market, you will notice in a moment that the S&P 500 and the equal-weighted S&P 500 have not had a particularly strong year. Now, what's funny about that is other areas of the market have not had have had a much better performing year. We need to move one chart ahead if we could, guys. Okay. We don't have a chart, so I'll explain it to you. I'm good. One thing you learn as a technical analyst is how to describe charts when you don't have them, so I can do it. Okay, no problem. So if you look at the year-to-date performance, right? What's happened to Bitcoin year-to-date? Adrian Zadunchik, what has happened to Bitcoin? Has it gone up or down? Up. Year-to-date. 70% higher, maybe? Yeah. I would say, right? It's fluctuated, as they do. But overall, it's pretty positive. And thanks, Adrian, for coming on my show recently. We'll have you on again soon, for sure. Other parts of the market, right? Meta, year-to-date. Pretty decent, right? Probably outperforming Bitcoin, I would say, with this most recent gap higher. This is the chart. Thank you. Oh, thanks so much, Julius. If you look, Meta, year-to-date, up about 90+%. Bitcoin is second. Then there's a big gap in space down to a bunch of things that have still dramatically outperformed the S&P 500 year-to-date. Amazon, still below its 200-day moving average, right there, just testing it this week, breaking above and now down a little bit, still up way more than the S&P. At the very bottom, below the NASDAQ 100, below the communications services sector, below gold, we have the S&P, and then at the very bottom, we have the equal weight S&P 500. If you missed the first panel earlier, I think that was Wednesday evening, with people like Craig Johnson, John Kolovis, talking about equal weighting indexes. Bob Pisani did a great job of sort of teasing this out. Equal weight means something, right? Because it shows you the average stock and what they're doing. It's not been a particularly good year for a lot of individual names. Leadership is another thing I'm going to ask Ralph about here in a few moments. So that is the situation we're in. That's where we've come from. Now I have two. Did I do okay?
Yeah.
Okay, good. Now I'm going to do is move over here and introduce two amazing panelists and talk about a fun task I was given, which is interview two mentors of mine and two legends in technical analysis on what they're seeing. So I want to welcome Ralph Acampora and Louise Yamada. Will you join me?
Hello.
Great. We don't get pictures here.
I don't know. Is there a way we can get the charts here if it's possible? So here's what I would like to start with, okay? And I'm not going to introduce you because I think everyone knows your backgrounds, and both of you have had such a great opportunity to share some of your experience. I really appreciate it. Ralph, I would say, observing you now in your natural habitat for the last 48 hours, you're smiling a lot. Now, you normally smile, but I'm seeing a smile on your face often. What is it that you're smiling about? What brings you joy about this particular event, if you could briefly?
Well, I got to tell you, meeting everybody, of course, is a joy. But to see the expression on your face and the passion that you have for the subject, I think I mentioned this in the opening comment. This generation has the same spirit, the love, the dedication, and the passion for the subject that we had 50 years ago. And that put a big smile on my face. So keep going, guys. We got at least another 50 years to go.
Right? It's
Yes.
been an incredible journey so far. We have longer to go as an organization for
yes.
sure. There's a lot of upside to the CMT Association, I would say. Thanks, guys.
get out,
We're
Charles.
all set here.
Okay.
Louise, you mentioned earlier you had a great panel with Abigail Doolittle and
We did.
and Katie, Marianne, talking about how you got started. For those of the people that missed it, what strikes me, and I know a number of you have talked about how we stand on the shoulders of giants. And Ralph, actually, I think on your opening remarks on Wednesday, you talked about guys like Ken Ward, who were the old guy. They were down the road, they were the Bob Farrells for people like me. They were really the people who have been doing it so long. You guys had an opportunity to work with people like Alan Shaw, I know you would consider mentors. Louise, can you just share for everyone, I know Alan couldn't be here, what was that idea of mentorship, an opportunity to learn from someone like Alan? What did that mean to you in your career?
Well, first of all, I have to say I don't think of myself as a legend.
But you are. And that has nothing. That has to do with you've earned it. You've
very
earned
hard
that title.
to internalize that. Working with Alan was really fun. I don't know how you define a mentor. It's not as though he came up to you and said, "Now, look at this, this, this." And it was the way he did things, and the way he repeated things, and the way he conceptualized things, that you had to absorb it. I mean, you had no choice, and it was really a phenomenal experience. I mean, I'll never forget when in 1987, when the market crashed, he was about to give a speech to all our international clients that had just come in, and the market was going to, he had to revise his entire speech within minutes, hours, whatever. And I thought, I don't know how he did it. It was just really incredible. And the other thing that he did, which, he did many things, but some of the outstanding ones was in 1985. Is it all right if I go on with
Please.
this? Yeah. 1985, he was convinced that interest rates were going to go down. And he did a piece called, he wrote a piece, and at the time, we had to lay out all the charts on these long tables. You had to put the date on every single chart by tape, nothing the way you do today. And I kept saying, Alan, you got to get it out. You got to get it out. It really looks like, rates are going to collapse. So we got it out, I think, 2 days before the actual yield broke down from this, 2-year top. It was an amazing call, and he went out and he said, we may never see double-digit interest rates in our careers, with the caveat that we could have short careers.
Oh, that's fantastic. I love that. I love that.
Wonderful.
I love it.
Yeah.
We're going to come back to interest rates in a
Yeah, I
minute
know.
because you have some really good charts that I want to share with you. Ralph, it's amazing what you can find online. So I did a little Googling of you. And one of the quotes that I heard about Ralph, and I don't know if this is a quote of yours or how it was described, but it was described that you use technical analysis to hear the voices of the market, which I thought was such a brilliant way of describing our discipline. What does that mean to you, right? When you're looking at a chart, how is that telling us about the voices of the market?
I think that I had too many drinks that night.
You were hearing voices.
Yeah,
Is that
I
what
was
they
hearing
meant?
the voices.
Okay.
No, I don't know if I actually said that.
Okay.
Yeah,
Someone described it probably. Described you as doing that. Why do you think charts give us a sense, or I guess inside the heads of the others?
In the book, you got to read this book. It's fabulous. Not because I had anything to do with it, but the comments and the observations. And in the book, I describe what technical analysis did for me. I was a history political science major in college. I got into the business. It's a long story. But I had no background. And then I was making charts by hand. And after many months of doing these charts, all of a sudden I had an opinion on gold. And people started asking, what do you think of the stock market? And all of a sudden, I had an audience. I don't know what a balance sheet looks like, but I knew what the charts looked like. And they empowered us. And that's the word I'd like to say. Technical analysis empowers you.
I love that.
Yeah.
That's a good
I feel like everyone in the room would agree with that, right? In some small or large way, we've seen that.
Yeah.
Let's talk about the markets if we could. And I think what the great benefit that I think you guys bring is I've always thought of charts as a history lesson. And you guys have certainly taught me to think about the lessons of market history. I think of Louise, you coming up to us at Fidelity in Boston, unfolding your point figure charts, and
Yes.
just fantastic discussions. Ralph, going around your barn in Minnesota and really talking about market history
great.
and how things looked and felt. Louise, if we could start with you. You actually published a piece, I think it was at the end of last year, beginning of this year, really talking about the interest rate and environment, but from a much longer term perspective in a way that we hadn't seen in quite some time. Can you talk to us a little bit about what we should know and how we should think about the trajectory of interest rates over the longer term?
Well, I think not just interest rates, but I think that one of the things that's really important is that you have to observe not just what's happening within the day or the week or the month, but what's happening in the long-term picture of whatever it is that you're following. And we follow so many different things. And I think that observing these longer-term trends is extremely important, even for traders, who should know what they are trading and within what long-term time frame they are trading it, so that they have an understanding of what the intermarket relationships will be in that longer-term trend. And I had just talked about Alan's call for the shift in interest rates, and you can see it on the chart there. In 1985, you can see the lower high and then the break of support. So for the first time since 1946, interest rates actually fell below a point they had not fallen before. And that has taken us into this long-term trend of falling rates. Now around 2009, we were looking for a turn, possibly a saucer. And one of the things to look at here is that interest rate cycles have been long, anywhere from 22 to 37 years. We are now 40 years have passed. We're in the longest falling rate cycle. We didn't expect the pandemic collapse to under 1%, which is on the next chart, which you can see very clearly what happened. There you are. We collapsed in the interest rate, and then we bounced back, and late last year, you actually broke through that 40-year trend. So what we're talking about today is the reversal of what Alan was talking about in 1985.
Absolutely.
40 years of falling rates. Now, I have a particular question to ask. I want to see how many people in this audience were in the last rising rate cycle from 1946 to 1981, professionally. Put up your hands.
Oh,
Hair color may be a good indicator, but I'm an outlier probably.
Okay.
But I think for
I was
many of
part
us,
of
yeah,
it. I
okay.
was part of
Okay,
it.
we do not have a lot of hands
many,
going
yeah.
up. The rest of you have never lived through a rising interest rate cycle. So you have to go back to 1946 to 1981 and study it. You never had an opportunity to get out with a profit in that entire, if you bought and held, because every pullback, didn't take you to a place where you could take a profit. And I think that that's something that we really have to take into consideration today. We have now ended the longest interest rate cycle ever in all this time. Now, one of the things to observe on the chart is that reversals from rising rate cycles to falling rate cycles have all been inverted V affairs. As you can see, it happened in 1981 when Volcker came and, raised rates so that we saw a drop in inflation and the rates came down. On the other hand, the reversals from falling rate cycles to rising rate cycles have been very slow, saucer-like affairs that have run from 2 to 14 years. So we've been looking for it in 2009, and then we got this new crash. So basically, what we have here is a 12-year saucer bottom that's taken place. And we have the reversals that have taken a long time, we think, because they have all experienced deflationary pressures. And it takes time for those pressures to reverse. Now, people are looking for rates to come off. They're not going to come off to new lows, in my humble opinion. But they will pull back, and then they will rise again for whatever the Fed does or doesn't do. It's not gonna make that much of a difference. So that is what we're looking at, and I think it's a very important cycle. And if we can flip ahead a little, we can go and see it in another perspective. I'd actually like to skip that one right now. Let's go to the last one. Okay, there you are. Okay, there is your 40-year downtrend. Your first time with the reversal of that trend have interest rates risen above the resistance level of multi-years. That's a clear breakout in this case. And the other thing that I think the confirming factor is the MACD below. And notice how throughout that entire 40-year cycle, MACD never raised above the blue line. So you had the buy and the sell signals for all the little interim pullbacks and whatnot. And now for the first time in 40 years, that MACD is telling you it's a valid trend. And I think that's the confirmatory piece of evidence technically. So at this point, until we see evidence to the contrary, I think you're going to have to go back and study that last rising interest rate cycle, because what you do in every aspect is going to make a difference. And if we think about the first chart again, around 5% is the level where interest rates have in history begun to affect the stock market. We're moving closer here in a much faster rate.
I'm still so surprised we're even thinking about 5. I mean, it's just for so long we've thought about ultra low rates. Ralph, can you so you guys, again, what's benefited is you guys have invested in a period of like this.
Can I give you something personal?
Sure.
In 1994, I bought an apartment in New York City, right lower Manhattan. And they charged me 10% mortgage. I kissed the banker that didn't charge me 12%. And for the last several years, I've been encouraging, where's Juan Fernandez? Is he here? I asked him, go out and buy a house and get yourself a 30-year mortgage. And I think Juan's got a 3% mortgage or something. I don't know if he's here. And I encourage everybody, because in your lifetime, you're going to see double-digit rates, for sure. And everything that Louise said is, she just took the words out of my mouth. And the red line is 5%. You go look at history. In 5%, when the interest rates went above 5%, I came into business in 1967, and these guys had the longest faces in the world. I'm saying to myself, first 15 years in the business, what the hell am I doing in this business? No one's happy. We couldn't get above 1,000 because rates.
Yeah.
It was Reagan when he started cutting rates, and that's when you started the 80s. And so, guys, that picture is worth $1 million for all of us.
And the
Thank you for saying
other
that,
thing to notice is that interest rates aren't going to go right up. It was a 35-year trend. But notice that
it bounces around.
Yeah, in the mid-'60s, you had a sort of a plateau. So, yeah, the Fed can stop for a while.
Oh, yeah.
That's the longest plateau that we've had in that rising rate cycle.
Yeah.
But it doesn't have to go up.
No,
it can stay there for a number of years, and I think that was 4 or 5 years.
It'll bottom out between where we are, between 3 and 5% for a while. It'll just.
Anecdotally, I remember it, and I can't mention who, but I remember a Fidelity fund manager who was a longtime bond fund manager. I mean, top ranked, had incredible performance.
Yeah.
Right about where that bottomed out, he retired, and he was fund manager of the year, and I asked him, like, why are you, like, you're at the top, like, you're doing fantastic.
Yeah,
and he said, it's gone, it's done. It's never going to be like this again. He's like, the rest of my life, rates are going higher. And so far, it's been 100% in line with what you guys have said. Yeah. And thank you so much for bringing monthly charts to the discussion. I love that you are helping everyone recognize that is the time frame we should be starting our thought process on.
Yeah.
Ralph, could we talk a little bit, switch gears maybe to the idea of narrow leadership? This has been a big debate in the markets. I showed the chart in the market recap about a small number of large companies have done exceptionally well. Certain areas of the market have been very strong, like home builders, like gold stocks, like big technology, communication names. But the average stock is having kind of a flat to down, challenging year. Talk to us about your experience with periods of narrow leadership and what we should take out of that.
Yeah, well, when I think of the Nifty 50s in the 19, I didn't say 1870s, I said the 1970s.
Whatever, right? One of those.
Well, we had a handful of stocks that held up the market and the breadth. I remember Johnny Brooks, the co-founder of Johnny, I was telling you about John, we were running around together. We turned to Bob Farrell one day and said, why are we plotting advanced decline line? Because it's been going down for 15 years. In that period of time, you had the Nifty 50. You know, IBM was a Nifty 50. Control Data, no longer around. Avon Products was a Nifty 50. And these stocks sat up there. And I got to hand it to Alan Shaw because I was working in 1973, 74. He nailed it. Point and figure charts had tops I've never seen. That's where I got that phrase: bigger the top, the bigger the drop.
Sure.
And you know what? We had a month, a regular monthly at the time was the MTA meeting, and I remember being a point and figure guy sitting around saying, "Oh my God, you know these tops look terrible," and the volume technicians said, "Oh, what are you worried about? There's no volume in this market." And I went back to Alan. Oh, and when they started to break down from the tops, I was putting up, and I'd be at these meetings, and, oh my God, these stocks are breaking down. And the volume guy says, what are you worried about? It's on light volume. And I went to Alan, and he said something so profound. He says, remember, young man, bear markets start on light volume. They end on heavy, bear markets end on heavy volume. And that's so very, very true. So,
It's an illustration of the point and figure charts that affected your thinking so much.
That's an original.
That's in 2000.
Bless you.
That's
look
in
at that.
2000.
Hey, it's just 1980. What? Is this 89? Yeah, look at this.
That's the 2000
Yeah.
top.
You don't see tops like this in the market today.
And here's
That's
the
why-
other one.
Yeah.
This one, I'm
what's that?
covering the name. This is Enron breaking down.
Oh, why?
Mark Dibble, who's attendance here, he used to share, and I forget what stock it was, but he used to love sharing an example of here's what it takes a fundamental
Good for
analyst
you,
to
that's
understand that a company's going bankrupt. He listed out this whole page of things, and here's what a technical analyst needs to understand a company's inbound. The chart, done.
Yes,
The
yes.
chart's topping out.
Yeah.
Ralph, if we could share, I know we just published an article on StockCharts, I think in the last week, featuring some of the work that you did with Julius DeKempener, talking about bucketing stocks and thinking about relative performance. Can you take a couple minutes about the Argonne model? And thank
Wow.
you, Jay Woods,
Oh,
for being a
there's
part of the
the-
picture
I'm-
on the article. But we wanted to just give you an opportunity to share what that methodology is, because I
talk
love
about
when
this?
we're able to build out the
Yeah.
the toolkit here.
About 15, 16 years ago, no, maybe 20 years ago, when I was at Prudential Securities, we had large institutional clientele, but we also had a huge retail audience. And I'm giving this presentation one night, I'm talking about the performance, the groups that are outperforming, underperforming. And two guys came up to me at dinner time and said, yeah, could you explain this performance thing you're talking about? And I wrote down on a piece of paper, you take the price of the stock, you divide it by the S&P 500, it either goes up, you're outperforming. If it's flat, you're even with the market, you're underperforming. And one guy says, wait a second. If my stock's up 30% and the S&P's up 35%, you said that's bad because I'm underperforming? I said, excuse me? He said, that's what you're telling me. I'm making money. Who cares what the S&P 500 is doing? Wow. And the second guy said to me, wait a second. I'm down 25%. Market's down 30%. You say that's good because I'm outperforming the market? What the hell's the matter with you? I'm losing my shirt. And that was the retail looking at what you and I accept the three trends of relative performance. But you're only looking at relative. You're not looking at the price of the stock. And for years, I would dabble and say, geez, you know, and I came up with this. You know what? There are not three movements between price and relative. There are 9. Stock goes up in price, relative is up. Stock goes up in price, the relative is flat. Price goes up in stock, the relative is down. Price is neutral, relative up. Price is neutral, relative is neutral. Price is down, neutral, relative is down. Relative is down, price is down, relative is up. And it goes on. And I was sketching this out for Julius, at StockCharts. About
was for ChartCon.
That was about 7 months ago.
Yep.
And he picked up on it. He said, well, let me work with this. And then we were communicating, and thank God, this guy picked up on it, and he says, I want to call it Argon. I said, what's that stand for? He says, Acampora's Relative Grid on 9. So I humbly give you a new view of price and relative. Think about it. Let me ask you a question. For your personal account, are you more interested in making a profit or beating the S&P 500? You better believe it. You better look at Argon then. I'm serious. I am dead serious. In fact, I presented this to an accountant out in California who's going to be my stepson's father-in-law soon. They're getting married. And I told him, if you're not beating the market, he said, who cares about it? And this is an accountant. He says, I want my customer to make profit, that's all.
And we should thank Matthew Verdow from Optima, doing a fantastic job of programming it. He's a fantastic and really designed it in a way we can see the results here. Yeah. You know, it's so interesting, and thanks so much, Ralph. I wanted to make sure that we highlight that. If you guys want to learn more about it on StockCharts, Julius and Ralph just published an article describing the methodology and illustrating, and we hope this is the beginning of
Did I shake you up a little?
Stuff.
Did I shake you up a little bit? No, really. They get your glasses on. I mean, it shocked me because I was forced at one point to answer this, but it took me years. And, you know, I'm talking, and I would just doodle on a chart. And you know, when, I don't know if Craig Johnson's here, but he bought the Mansfield charts. By the way, if you want Mansfield charts, he's got it online now.
Right.
It's wonderful. When he started giving me every Saturday morning Mansfield charts, guess what? It has relative strength on there. And I do the Dow 30 stocks every morning. I've been doing that for years now. And they're in 9 categories. And when you put an oscillator on it, I'm not saying it's perfect, but you get very oversold conditions at bottom, very overbought conditions at top. Hey, folks, it's a gift. Enjoy.
More to be done there for sure.
Yes.
You know, it strikes me as we're sitting on, I think there are less and less people in a room like this that have worked in a firm with a physical chart room with paper charts. And that is one thing we've all experienced at Prudential, at Smith Barney, at Fidelity. Louise, can you talk a little bit about, just briefly if you could, because I want to get to polling the audience here in a minute. Yeah. Can you talk about that experience of being in a physical chart room? I remember visiting you and looking at charts. Ralph, I remember visiting you in the Peru War Room, and just what a fascinating space it used to be. What did that mean, and why was that an important part of your process as a team?
Well, when you're plotting all the indicators every morning, you have a feel. I mean, you've done the math, and we did the math by hand too, you know, in the book, on the grid, on the charts. And you know what number's coming off, you know what number's coming on, and you have a feel and a sense of which direction that means it's going to be. Is it going to give you a divergence? Is it not going to give you a divergence? That sort of thing was very important. And when I think I did the charts for 15 years. I didn't want to give it up, even when I was a vice president or whatever, managing director. Hated to give it up, but I did, because, you know, you really wanted to get the feel.
Yeah, Ralph, what would you say?
Go ahead.
Go, that's all right.
I have a fun story. I moved to Minnesota about 15 years ago. I went up into the attic, you know, to move boxes, and I found these boxes. I hadn't opened in 20 years or something. And it was my war room. I had the war room in Wall Street. You guys had it in Midtown.
Right.
And I had charts that I laminated them, so they were still in good shape. I had wall charts that were 8 feet high, 22 feet long. I had 4 walls like that, you know, all different that. And I called up Phil Roth, my buddy. I said, Phil, guess what? The war room is alive. He says, do you have the wall chart with the 3 Dow averages, the Dow Industrial, Dow Transport, the Dow Utilities, and moving averages and notations of what happened? I said, yeah. He said, you got to bring it down to Wall Street. There's a museum down here, the Museum of Finance. They're doing the 160th birthday of Charles Dow. So I bring the chart down. I'm laying it out on the floor, and the lady says, can I cut it? I said, I'll kill you. Cut my chart. What the hell is the matter with you? I rolled it up and I was walking out the door. She said, no. Mr. Acampora. And they made a cork wall, 8 feet high, 22 feet. And that was the backdrop. Listen to this. And 6 months later, she calls me up. She says, Mr. Acampora, the exhibit is going to be ending in a couple of weeks. Would you donate this? She said, this is one of the most unique things we have in our collection. I said, absolutely. And then she said to me, she said, this little museum is part of the Smithsonian Institute. So guys and gals, we have a chart hanging somewhere in the United States, and I hope they didn't cut it. That's a true story.
Fantastic, you guys.
Yeah, I couldn't make that up. That's a true story.
I would love to get the audience involved here, hear what they're thinking, and then we can sort of review the results and talk about them as a group. If you guys wouldn't mind getting your phones out, now's the time. We would love to poll our audience here in New York and get some opinions about the market. They are unattributed, meaning no compliance issues. Vote your conscience, and we'll see what you think. Question number 1, where does the S&P 500 end the year? Below 3,600, between we'll say 3,600 and 4,250 or so. Okay, hold on, this is a little different. We'll go with this one, though. Vote your best options on this page. We'll see what we come up with. Wow. We're making new lows. We're stuck in a range. We're above, and then we'll say above all-time highs means we get above 4,800, and we'll see what that means. So right now, we have about 10% of the audience pretty bared up. Below 3,600, it's not that far away, but it's definitely making a new low for the getting down toward the lows of the cycle. Are we range bound? That's probably the biggest answer, as we're sort of stuck in this range. So it seems like the biggest respondents would be sort of in that range bound sort of area. Do you guys agree with that general sense that, I guess, the choppy slop is the way I described it earlier, and Ralph, we were at dinner earlier this week. That phrase came up a couple times. Yeah. Would you agree with that characterization of the market here?
Before I do that, hey guys, October 13th was the biggest outside day you've ever seen in your life. Do you know how many points the Dow that day between its intraday low and intraday high? How many points did Dow gain? 1,501 points. In one day? That to me was the bottom. And we had that debate at dinner that night. But I am really convinced that I've seen some bottoms, boy, and that one just smacked me in the face. Now, are we up in here? Are we going to mumble? When in doubt, I mumble. Well, I think the market's going to consolidate. Honestly, it's your call. Did you expect the market to be up 500 points yesterday? I think they did it for our party, but
good timing with the event, right?
Yeah, and again, the last I looked, the Dow was up another 129 points. Again, so I think we're gonna try to make new highs. Yes, I am. And you're talking about the rotation. Remember one thing: rotation is the lifeline of every bull market. And yes, we had technology lead, and the financials look terrible. Guess what? Maybe you'll lighten up here and buy a little down here. I think you're going to start seeing this rotation continue. Oh, yes.
Louise, how would you sort of answer this sort of question between new lows, new highs, somewhere in between, and why?
I think that what we have to factor into this now is the realization, if you will, that we're in a rising rate cycle. And it's going to depend on what the rates do here to what the market can do. The other thing that I was very interested in talking with Craig Johnson is he had a little chart of his showing how the stocks in the New York Stock Exchange, in the S&P had declined so much over this period of time that you're going to need more money going into the fewer stocks. That's a possibility, but also that a lot of what's moving up here is technology again, and whether or not we're going to see a secondary rollover. I think there are a lot of questions from my perspective as to what's going to happen.
Are you mumbled?
I'm
You know what the great words in technical analysis of mumbling? What do you think of a market wrap? Well, I think it'll consolidate and stabilize the current level. So, it'll go back and fill a while. Yeah, those are mumble words. Well, I use them a lot.
All right, so if we could cue up the second question. This should be the one about consumer discretionary versus consumer staples. If we make sure we got the right one ready. If you guys could get ready, we're going to ask you, what would you most like to own over the next 3 months? Consumer discretionary, consumer staples, or cash, consumer nothing? And the reason why this is an interesting question to ask is because I always describe it, consumer discretionary things you want, Consumer staples, things you need, right? When things are good, you buy a new car, you buy a nice watch, take trips, go to hotels, all of that. When things are better, right, really at all times, you're still buying alcohol and tobacco and weed, apparently more and more in the New York area, and other things, sort of those no matter what type, toilet paper, personal goods. Which one of these would we rather own over the next 3 months? And it could be closer to all even, but not by much. This is pretty well distributed between offense, defense, and what's so funny is cash was always like a placeholder because you got nothing for it. Now cash is actually a legitimate investment vehicle again, right? With your CD making 4 or 5%.
Well, they're
Don't
mumbling.
we have some technology and discretionary?
No, so I limited it to just
Oh,
three
you
this time.
did?
Yeah. So,
Okay.
so I'm taking technology, communication services
Yeah, yeah.
also. I'm
No,
just
but
thinking.
any
going like this.
discretionary, do we have any names? Technology?
That's a mumble.
No. I mean, things like
Names.
Amazon, right?
Yeah,
Would be in
well,
there. That's
okay.
Everything's technology.
Yeah, everybody's
Okay.
even, so that's a mumble. You're
This is-
consolidating.
Staples, the
hard
number
call.
one answer, but not by much.
Much.
This is pretty
No,
evenly split.
come on.
If you guys had to pick one of those three to own over the next 3 months, what would you answer and why?
Well, discretionary now looks better, right? I think, yeah.
Yeah.
You know,
I'm in cash because I like to have 5%.
there you go.
Don't we all, right?
And I'll stay with the trend, as long as the trend, consumer, discretionary is, again, I'm assuming that, at last I looked, maybe a day or so ago.
Yeah.
They looked pretty okay.
No, what's interesting about this question, if you think about it, certain areas of staples have actually come on really well recently.
Yeah.
So like beverages, like Pepsi,
Yes.
food
Hershey.
products, right? Hershey's,
Hershey,
General Mills
Mondelez.
are actually
Yes.
rotating higher. What is it? I mean, does that concern you? Is that an okay thing that some really defensive stuff like staples all of a sudden starts to work?
Yeah.
Is there a signal there that you guys would think about thinking back over time or no?
Yeah, again, I'm mumbling, but yes, you're right, that would concern me, but look at what NVIDIA did, and look at the technology stocks.
Yeah.
Come on, guys, I'm long a couple of those things now, and I'll play both sides. Yeah, I will.
I didn't give all as an answer, but maybe that's what we're implying as a
Yeah,
group.
hey, the trend's your friend, man. Draw that trend line, I'm with you.
When in doubt, follow the trend.
Oh, always.
Can we
Remember,
get-
you own price, you don't own the RSI.
Hmm.
Trend is your friend. Price is the most important thing you can do. Look at, that's the first thing you look at on a chart. And learn how to draw a correct trend line, please. Take
You've
my
mentioned that
class.
a number of times.
Yeah.
I'm getting a little bit of a vendetta in your voice, but I think
Well, no, I
well-founded.
am. And you know
It's
who
true.
beat on me
It's
was
true.
Alan.
Oh,
Yeah.
yeah.
Oh, my God, you draw that trend, boom, he slapped me in the hand. Come on, come on.
Yeah, I
Oh,
can't
yes.
tell you how many
Yes.
poorly drawn trend lines I've
Oh,
seen.
my God, that was his
True.
big argument.
Yeah.
Can't draw a trend, get out of here. You don't know what up is, or down is. Hello, look at, right, Ken?
Yeah.
Yeah, the old timers talk that way.
You guys strike me as very supportive mentors, certainly for me. Alan seems like a little more of a taskmaster kind of mentor
Well,
at times.
not really.
And he reminds me of the
I never
chairman
saw
of
that.
the chairman
Yeah,
of
no,
Fidelity
I'm
was
only
always like,
kidding.
if he saw a chart that was not a log scale chart,
Yeah.
we got promptly scolded of no, get that out of here.
Yeah.
It needs to be log scale. Can we get to the final poll question if we could? I wanted to ask you one more thing and then get you guys to talk about multiple timeframes because that's I think an important lesson, certainly for newer technical analysts. We're going to ask you what time frame do you tend to use the most, right? What time frame do you use the most on charts? And I think I have intraday, daily, there we go, weekly, and monthly. Thank you guys. If you could vote real quick. And we think about it, of course, they're different, we've talked a lot about what does the chart say about something, but timing matters, right? The time frame kind of matters in terms of where we're looking at it. Let's get the results in here. We're seeing sort of a
gosh.
grouping here in daily and weekly. We've got a
Okay.
small subset of the group that are more intraday, a little more swing trader, day trader time frame. A very small number who I'd love to talk to each of you outside afterwards just to see how you're starting with monthly. That's actually really fascinating. But mostly in the daily chart range. Louise, can you talk about what multiple time frames means for you? What does that
It's
inform
very
your process?
important
Yeah.
to me. It's important to me. I mean, I'm not a day trader, but I think those of you who are mostly looking at daily charts really have to start looking longer term. I like to use all three. Use the daily charts, and I
absolutely.
use them all with the MACD. And you want to see them, you know, in the daily chart. If you get a sell in the MACD, you've got a short term. If you want to trade it and go wait till it comes back. But then I want to see how that weekly is functioning. Do you have, you know, for a more intermediate term? And the monthly charts I find extremely important in terms of the MACD. They give you your long-term signals. And right now, unless today has changed it, all of these three indexes, the three markets, the Dow, the S&P, and the NASDAQ, have not given a monthly MACD buy signal. Are they curling up? Yes, they're curling up, but it hasn't happened yet.
Ralph, when you think about multiple time frames, why is that important for a new analyst?
Again, the firms that I work for, fine brokerage firms with large audience, no way was I day trading. That to me was tantamount to gambling. And we
weren't allowed.
Yeah.
We weren't allowed.
Because you couldn't do that. And what my clients, what my bosses told me, we want you to write a 50-page report and put it on the client's Christmas tree, because that's your long-term forecast for the year, okay? And then every week you update it with your weekly board. And I had a guy doing daily charts, you know, sure, and trading, but not intraday. I totally agree with everything that Louise said, daily, weekly, and monthly charts. I don't care. I look at all three. When someone asks me a question, I look at all three. I have to. Personally, this is me, I like weekly and monthly charts because I'm really kind of an investor. My wife pulls the trigger. I mean, she runs the show. But I come downstairs from my man's cave, and I say, "Hey, gee, you know, honey, that NVIDIA looks good." I said, "All right, get out of here," you know. And she'll trade it a little bit. Anyway, so weekly, monthly bar charts. But I totally agree with Louise. Daily, weekly, monthly, and everything you look at.
What strikes me so much, having been able to receive your research when you guys were publishing it at the firms we mentioned earlier, it always struck me I would get so sucked into the short-termism, what I call the flickering ticks of the market, and Louise and Ralph, your work would always sort of help me think about the bigger picture if we could. I would love to ask you this, and I should tell everyone, you may or may not be surprised to know, we talked a little bit about this panel, but I basically told them I'm going to ask them some questions and we'll see where it goes. And I trusted that this would be a lively conversation and a really fascinating one, and it's been. I would love to ask you this. Both of you have written books over your careers. I would love to know randomly, if you wrote a book today about the markets and your experiences and what you're thinking, what you've seen and heard, and what you're thinking going forward, what would the title of that book be today?
Oh, what would the title be?
This may be a tough question to pin you on, but I'd love to think about it. And if you want, I can share you titles of the books you have read, because I know them.
Yeah.
But you probably know them as well.
Yeah. Well, I think something having to do with change at this point would be structural reversals, structural changes in the market.
Yeah.
Last one was market magic, but it was magic for a while. But the last part of it is still valid. I mean, but basically I think it would have to do with another major shift. We wrote about major shifts.
Yeah. And can you jump just a moment, Ralph? I'll give you another minute to think of your title. But Louise, could you talk about, because I get a lot of questions about AI or some new thing, and I feel like I've only been in the industry 23 years, which is not nearly as successful and long a career as you guys have had, but all I've experienced is change, and we're still here analyzing charts just like we were in 2000 when I started. How have you dealt with dramatic change at times over your career, and what can you tell those of us earlier on that are struggling at times with the fact that the markets just keep changing so much?
Yeah, I think you have to understand what's underneath, what the internal picture is. I think we dubbed old tech, new tech. I did in 1995. I mean, you were seeing so much change taking place then, and everybody's expecting materials and industrials to come back, and I'm not convinced they're going to come back in the same way, because the new tech, and even technology today, is going to probably come back with new leaders, or one or two that can sustain another decade or two, but you're going to have new technologies, and I'm always reading to see what are some of the new ones. You know, you read it in IBD or you read it in Barron's, maybe not so much, but IBD, you get some nice names to watch, and they start to break out, and you see these long bases. I have bases too here, but anyway.
Wow. I get it.
And Ralph, it strikes me when we've talked about it, I mean, just how much the markets have evolved over time, and just how, you know, you've had to deal with change over time. What would you tell a younger analyst struggling with
People ask me that question slightly differently. They say, Ralph, you've been doing this for over 50 years. Has anything really changed for technical analysis? My answer is no. No. Buyers and sellers, supply and demand, it's all the same. I'm not a fundamentalist, and yeah, technology changes, and God, I need a 10-year-old kid to program this thing for me. I don't know. I'm a nerd when it comes to technology.
Me too.
But I can read a chart. That's all I need. Keep it simple.
Yeah.
Alan Shaw said that.
Keep it simple.
When in doubt, keep it simple.
And the title of my book would be Fusion Analysis.
Okay.
Because I think technical analysis, you know, let's face it, we're all here, technical is the best. No, it's part of the process, you know. And over the years, you know, it's us and them, you know, and that's why Johnny and I fought so hard, because they were just beating on us. The fundamental community, they were nasty. So and over the years, it became us and them. And in reality, no, it's you want to use all the factors. You know, research is economics, fundamental, quantitative, technical, fusion. I would say. I'm not smart enough to put the other three pieces together, but I would get help, and I'd call it fusion analysis.
Louise, you've shared a number of charts with me, and I'm thinking Bruce Kamek, when you told me when I took over a course at Brandeis, I asked you for guidance because you were teaching at Baruch at the time, and you basically said, make them draw bar charts by hand. That was your main suggestion to me, so they would learn what that means over time. Louise, if we have to wrap the show here in 2 minutes and 30 seconds, any final comments for the crowd here and the crowd virtually about what they should be doing, how they should brace themselves for what is to come here from a technical perspective?
Oh my goodness. Well, technicals, as Ralph said, I don't think the technicals are going to change. We just have to keep an eye on it. And keep an eye on it in all three time frames, and keep an eye on it in light of reversal in interest rates, and we'll see if that continues.
Yeah.
Ralph, a closing thought for the audience here.
Well, I agree totally with Louise. Just relax. Take a nice deep breath. Try not to get too emotional. I mean, we all do, but you know. And just take the graphs for what they are. By the way, get fresh data. You know, don't use old charts, and go through the process. You know, what I do is, well, the first chart I look at in the morning is corn, because I have a farm in Minnesota and I want to know what the corn is. But then I look at the Dow and the S&P, and I want to look at the transportation average, because I'm an old Dow theorist, you know. I want to see if that's working. And I go right down, and the next thing, after looking at the NASDAQ and all, then I look at the sectors, you know. Yeah. And if I see a sector or two that I like, then I go into the sector and, you know.
Oh, and sectors, relative strength is very important, especially the monthly. Forget the daily and the other, but when you want to see a major shift, in 2007, we had a...
Hold that thought if you could.
Ooh.
I want to say a thanks and a goodbye to our virtual audience, because we need to move on to the next show on StockCharts TV. We are going to spend a few more minutes finishing this conversation, but everyone not here in the room in New York, thank you guys so much for joining. Be well, stay safe. We'll see you again next week on StockCharts TV. Thank you, guys.